We do get inflation numbers out this morning in about 45 minutes. Is the U.S. economy ready for liftoff? According to the latest survey by the Wall Street Journal, an overwhelming majority of economists are expecting the Fed to raise rates as early as next month. Joining us right now is Stifel Nicolaus portfolio manager Chad Morganlander. Chad, good to see you.
Great to see you.
Welcome to the conversation. You think the Fed raises rates in September?
September, October, they'll lift off. Even if it's January, what does it matter anyway? Every day I wake up, it's Monday again. Yeah. What does it mean to the overall economy? Really, rather nothing. For the financial markets, on the other hand, we do believe there will be volatility over the next 3, 6, and 9 months.
I think this is a really good point because you're saying it's not going to mean much for the economy over the short term, but for the markets have expectations. So is an increase in rates priced in, or when they do raise rates, is going to be some kind of a surprise that we see a sell-off in stock?
I don't think it'll be a tremendous surprise where the market sells off by 20%, but the volatility will increase, as well as perhaps you get that 5, 7, 10% correction that everyone's been looking for.
Gary, what do you think about that?
I kind of disagree with you on I think, hasn't it already been baked into the market? Hasn't the Fed telegraphed this like 1,000 times already?
We keep getting weak data. We keep getting weak data to get them off track.
Also, Gary, if that's the case, then the probability in the futures market would be 90% or 100%. September probability of the futures market is roughly about 40 to 50%. Okay. So we just believe that
it's not a slam dunk.
Yeah, look, valuations within the overall market are somewhat elevated. We believe that overall total return over the next 12 months, about 5%, including dividends. We're just the market, we don't believe will have that get up and go over the course of the next 12 months.
Well, instead of looking at the market, do you need to start looking at areas of the market and even individual stocks that aren't overvalued? Like we keep talking about energy, and just when somebody will make an energy call and say energy's a buy, incredible dividends, those stocks will sell off again.
Right. The reason why that's happening is because energy is pricing off of oil prices. Oil prices are looking at global growth. Global growth is decelerating. We all know the story about the supply issues. The demand curve, on the other hand, has been somewhat moving lower. That doesn't mean that there's less demand. It just means that the overall growth is going to be somewhat muted. So what does that mean? Global growth expectations are for 3.5% by the IMF. We have it roughly at 2.75 to 3%. What does that mean for the price of oil? Oil price, perhaps it goes to the low 30s. Hence the reason why you're going to start to see continual pressure over the course of the next 12 months on energy companies. Not only the equity pricing of the stocks, but also look towards the fixed income market, in particular the high yield market. Hence the reason, and I need to put this in here, the reason why the high yield market has been selling off a great deal. The market on the high yield bonds, spreads have widened. Okay. But stock market hasn't really corrected all that much. No. So you have to take that as perhaps an indicator that
I think that's a big deal for oil to go into the 30s.
Buried in there, you made one great pick, I think, that a few people have seen. Why not invest in volatility? You know volatility is going to increase, right? Why couldn't you start buying the VIX?
Well, that's
or the
true,
futures,
but
right?
Most viewers that are watching this show are not hedge fund managers. That's right. What we would do is suggest that clients move up the quality spectrum, meaning buy more stable companies. Look at Dr. Pepper, look at Pepsi, look at a Coca-Cola or a Procter & Gamble, or, for example, Hershey's. Maybe perhaps reduce your risk on the equity side. Instead of having yourself overweight equities, just reduce it a bit.
And that's what you've done. You like consumer staples, like some of the names you just mentioned. You like healthcare. You like technology. And I know you own Cisco. It reported this week.
Yeah.
What did that report tell us? Because I'm trying to get at capital expenditures. A lot of people said that for the longest time, businesses were going to start spending money. I guess the Cisco quarter showed us that budgets are up.
So CapEx spending for technology is still continuing to improve, but still at a glacial manner.
Right.
It's not like it was back in the late 90s, as we all remember. So for the Cisco call, it basically was revenue growth. We only needed revenue growth of 4 to 5% to say that Cisco was undervalued, and that's why we bought Cisco. But we also like, and we mentioned this before we went on air, Microsoft. We're overweight Microsoft. We've owned Microsoft. Revenue growth there, 5-6% as well.
Apple, down 13%.
We don't own Apple because
but you guys upgraded Microsoft yesterday.
We did upgrade Microsoft. We believe that will go up about 10-15% over the course of the next 12 months. Our long-term forecast for Microsoft is about 8%, 9% total return.
What's the most exciting company you own?
You know what I like? I like Hershey's.
Hershey's.
We just bought Hershey's and Dr. Pepper recently. And I believe that those two companies, if you're looking 3 to 5 years out and you go to sleep and you don't worry about anything, they'll work out. You'll get a good rising dividend and you'll get a total return of perhaps over 10% in those two companies on an annual basis.
You like U.S. stocks right here as well.
I do. I like to look at the flip side, but yeah, I'm with Chad on this. I like U.S. stocks.
The general thematic here, Maria, is that we believe that the dollar will continue to strengthen. The U.S. economy will continue to improve, but much greater than its trading partners like the Eurozone, as well as the emerging markets, in particular China.
And individuals own too many bonds, quite frankly.
Yeah, but even with bonds right now, what we would do is tell individual investors to ladder their bond portfolio in good, high-quality bonds, go out year 1 through 10, and just call it a day. You don't have to predict the yield curve.
Great analysis, Chad, as always.
Thank you.
Thanks so much. Chad Morganlander joining us there from Stifel Nicolaus.